Hey everyone, we got some big news out of ARM Holdings as this AI stock continues to impress stock market investors. So in this video, we'll go through and we'll look at what these latest developments are and what these latest developments could mean for ARM Holdings stock investors. So let's jump right in. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now. So the company's CFO, Jason Child, gave investors a great deal of information that we need to digest here. And let's start with the guidance for fourth quarter. They're guiding to a range of 850 to 900 million with a midpoint of 875 million. That represents a 95 million increase compared to their prior guidance. So previously they thought their revenue was going to be roughly around 780, 775 million at the midpoint. Now they think it's going to be 875 million at the midpoint. So better than expected. And again, this goes to highlight the increasing demand for companies delivering AI technology, AI improvements, and AI improvements in development. So for the full year, guidance rises to 3.155 billion to 3.05 billion. That's an increase of 160 million at the midpoint versus the prior estimate. So not only is the fourth quarter, but the full year is going to come in better than expected for ARM Holdings. Interestingly, the company generates about 35% of their royalty revenue from smartphones, and they've benefited from the recovery in the smartphone market. 65% of its revenue comes from beyond mobile, and they are seeing more revenue growth from share gains and market share growth outside of mobile. So double benefits here for ARM Holdings, both the smartphone market improving and the markets outside of smartphones improving as well. And this replacement cycle is going to be bolstered by AI technology being implemented more so on smartphones and other devices. You could think of areas where there's need for significant improvement. One such area is the assistants, right? For example, for the Apple iPhone, Siri seems to be behind in terms of technology. It's not as effective as you think it should be, or as I think it should be, compared to other technology that's available. And I would be impressed if Apple could increase the innovation in that area, increase the effectiveness of that technology, and certainly that would take more computing power to generate that improvement. And that's something where companies like ARM Holdings could benefit, as it says that industry-wide, not just smartphone makers, industry-wide, companies are looking to add more technology in their products, and that's good news for ARM Holdings. So demand for their latest technology remains high as customers need to access AI-capable CPUs and related technologies such as our compute subsystems. So across the board, AI-capable technology is increasing in demand. And remember, 2021 was a surge in purchases of consumer electronics, things like smartphones, tablets, computers, TVs, etc., etc. Several categories of consumer electronic sales surged because people were spending more time at home. People were not able to spend money on away from home services like haircuts, like restaurants, bars, travel, things like you would do outside of the home. They were restricted to some degree, and so people spent more of their money than usual on hard goods, on things like consumer electronics. And then to top it off, people had more money during those times because of all of the stimulus money being sent out by governments worldwide, most specifically in the US. Several rounds of stimulus were passed in the US. And so that was great news for consumer electronic companies in 2020, 2021. And now what you're going to see is the replacement cycle. So for those devices that were purchased in 2020 and 2021, they're going to start getting replaced around 2024, 2025, 2026, because those are long-lasting goods, at least for several years, right? You think about a smartphone, you use that for at least 2 years. You think about your tablets like the iPads, you use those for at least a few years. Computers on average get used for about 4 to 6 years. TVs another few years, right? So those devices are going to start getting upgraded. And when they start getting upgraded or start needing to be replaced, that's going to fuel a huge surge in that replacement cycle. And even more so because this latest generation technology is going to be infused with AI, which is going to make people want to upgrade even more. If you've got this last generation product from 2020 and 2021, and then in 2024, 2025, 2026, the newer generation includes AI capabilities that are attractive and innovative and get consumers to want to upgrade. That's going to create another surge in demand for these products. And certainly that's an area that ARM Holdings is benefiting from. So for EPS, earnings per share, revenue growth will flow through to profit, driving Q4 non-GAAP diluted EPS between 28 and 32 cents, and full year EPS between $1.20 and $1.24. In summary, the CFO is saying we had an outstanding third quarter and we expect our momentum to accelerate through Q4 and beyond. So our third quarter was excellent. We think our fourth quarter is going to be way better than our third quarter. And then even beyond that, we think we're going to do better and better. So it wasn't just a one-time surge in demand that they're seeing, but they're seeing this flow through and they expect their prospects to be excellent for the next quarter and beyond, which is great news for ARM Holdings stock investors. They've already seen their stock price increase significantly. And given the way the CFO is talking, there could be more gains to come. Although I will say the stock is already very expensive. It's trading at a forward price to earnings of 80. So it's already expensive. And because of this valuation, I have not recommended ARM Holdings stock as a buy. I've put it on a hold because it's so expensive. Sure, it has excellent prospects, but very much of those excellent prospects are already priced into the stock, in my opinion. I think investors can get better risk versus reward right now in the market, especially considering the operating profit margin. It's been on a downward trend here. We don't have a lot of data for ARM Holdings. Remember, it recently IPO'd not too long ago, so we don't have too much data. But the data we do have is not looking great for operating profitability, 1.57%, moving in the wrong direction. Understandably, you have to acknowledge that the company is investing in research and development in this massive growth opportunity they have. So that's one of the reasons why operating profit margin is down a little bit. I expect it to recover. Still, when you're paying that high of a valuation, you want to see everything looking great. You're not looking at a company that's trading at a relatively cheap price where you're willing to accept some pluses and minuses when you're making that investment. Not for a company at a forward PE of 80. I'm looking for everything to be perfect when I'm paying that high of a valuation, which is not the case for ARM, right? They've got some downsides here, including a declining operating profit margin, which would make some investors like myself hesitate before going in and paying this much of a premium valuation. Before I let you go, let me tell you about the greatest deal on YouTube. With just a click of a button, you can get free financial analysis from a professor with decades of investing experience. So what are you waiting for? Hit that subscribe button, and I'll see you again soon.